When we look at it in aggregate over, portfolios, if you will, because, anybody has to look at it through a lens of a portfolio as opposed to individual loans. On average, if you look at it, that relationship between liquid and illiquid, if you will, direct lending in particular, has remained relatively constant, and in fact is slightly higher than post 2008, 2009. And that relationship, although liquid loans have tightened in over time, and especially in the past month we've seen them tighten in, it's a relative spread between the two has remained relatively constant.
I'm wondering, from your perspective, how much do you see this increasing where pensions just go directly into both private equity and direct loans without an intermediary?
Well, I mean, you started seeing that back when CPPIB started doing that in 2005. And, we see it across the board with a lot of different plans that are trying to migrate towards that. I'd say the number one thing, however, is you have to have the appropriate governance structure in place to make that work. And what that means is, do you have a governance structure that allows you to put in place teams that can go direct versus going through managers? And will those plans be able to bear the cost? And there's quite a substantial cost involved in going direct versus going through funds.
Given your vantage point right now, where you can really see what a lot of different pensions and other institutions are doing right now, do you feel like they have the correct understanding of what returns will be over the next 5 to 10 years?
Well, certainly across all asset classes, there's pressure on returns, right? It doesn't matter if you're in equity, if you're in real estate, if you're in credit. They're under pressure, just given the amount of capital that's coming into the space, generally speaking. Generally, the trend is most plans are recognizing that those returns are going to be lower in the future than they have in the past. I mean, that's what we're observing, more or less. And as a result of that, people are trying to adjust their portfolios to position for that. And again, I go back to, that's why you've seen such a migration from liquid into illiquid assets, because if you can invest over the long term and feel comfortable over the long term investing through cycles, then the ability to pick up that illiquidity premium is quite valuable to a plan or a pension plan or insurance company, et cetera, for their beneficiaries, for their policyholders, for whoever gets paid out of those endowments. It's very valuable.
How big is that liquidity premium when it comes to how much larger the returns could be on a subset of private assets versus public securities?
Obviously, it depends on which security you're looking at. It depends on where you are in that risk-return spectrum. But broadly speaking, and this is true in credit more or less, it's between 100 and several hundred basis points relative to the other risk-adjusted liquid assets that are out there. Now, that moves over time, obviously, but generally speaking, that's what's been observed in the past. Will that continue in the future? Who knows? If you know, that would be great. Let me know. I'd be happy to put that into my thinking. But I think right now what we observe is there's still a premium in the marketplace.
Some people say that in the next downturn, there'll be disproportionate losses within the private debt markets just because of how much money's come in and how inflated some people view the valuations to be. What do you say about that?
I think there's two things that I can tell you with certainty. One is in the liquid markets, with covenant light being north of 85% of what's been done in the marketplace in leveraged loans, and then in the private market where there's been a loosening of documentation, definitely, and we see that as well, that means over time that the probability of default is going to go down. Because you don't have a reason to bring somebody back to the table if you don't have covenants or you've loosened your covenants. That's point one. Number two, though, and we're observing this already, is the severity of a default is going to be much greater. So, i.e., the amount of money you're going to recover in a default situation is going to be less. And we're seeing that already. So what does that mean? Well, from an investment perspective, from where we sit, it means two things. One, we're late cycle. We all agree on that, or most people would agree on that, that we'd say diversity of your portfolio, not just in terms of individual strategies, but across strategies is very important. And that's something that can protect you to some degree against those defaults. And then number two, which is very important compared to maybe 11 years ago, is that as a credit investor in particular, it's much more important that you understand the underlying enterprise value of entities that you're investing in, because your margin of safety is critical with respect to the investments you're making, because in the old days, you could step in a lot earlier in a situation when things were degrading with respect to a credit so that you could protect your margin of safety. And today, you've got to be really certain of that, especially as you said, as multiples are up. And with EBITDA add backs, et cetera, it makes it even more inflated with respect to how much leverage you have on some of these companies.
So know what you own. And I'm
know
just
what you own and be very thoughtful about the underlying enterprise value. So understanding those companies, those industries, those sectors, how the macro affects the overall micro, which is really more important now than it was perhaps 10 or 11 years ago, all very critical.